The gross profit margin formula takes you about 30 seconds to learn. But the mistake most business owners make isn't a calculation, it's what they do with the number once they've got it. So here's the formula. Revenue minus costs of goods sold divided by revenue multiplied by 100. That gives you your gross profit margin as a percentage. Costs of goods sold, or COGS, covers the direct costs of producing what you sell. Materials, direct labor, inbound freight, not rent, not marketing, not your accountant's fees. Those are operating costs, and we'll talk about that later. A quick example. You bring in £100,000 in revenue. Your COGS, the direct costs of delivering that, total £40,000. Gross profit is therefore £60,000. Divide by revenue, multiply by 100, your gross profit margin is 60%. One common mistake, if you're VAT registered, use your ex-VAT revenue figure. Including VAT in your revenue number will make your margin look artificially low. So the mechanics are straightforward, but here's where it gets more complicated. Once you have your number, the instinct is to ask, is that good? And that's where people go wrong, because there is no universal answer. A 60% gross margin could signal a healthy, well-run service business. But in a grocery retailer, that same 60% would suggest something has gone seriously wrong with the cost structure. Grocery retail typically operates on a much tighter margin than professional services or software, where direct costs are low relative to revenue. The margin only becomes meaningful when you compare it against businesses in your specific sector, at a similar scale with a similar business model. Benchmarking against a universal number that doesn't relate to you is how confident decisions go badly wrong. So, calculate your number, then find your industry reference point. To do that, there's things like trade bodies, sector press, and companies' house filings from comparable businesses, and they're all useful starting points. But even a solid industry comparison only tells you part of the story. Gross profit margin only accounts for direct costs. It says nothing about rent, salaries, utilities, marketing, or any of the other costs that keep the business running. A business can carry a strong gross margin and still be losing money once operating costs are counted. That's the net margin. And you need both figures before you can draw any real conclusion about financial health. Think of it this way. Gross margin tells you how efficiently you're converting sales into profit at the product or service level. Net margin tells you whether the whole business is actually viable. So the decision rule is this. Calculate gross profit margin using the standard formula. Compare it within your own industry and not against a universal standard. Then check your net margin before acting on what you find. And that sequence is what makes the number useful. If that was of value, subscribe to the channel for one real business question answered every video. And for the same clarity in writing, the website and newsletter is at 5minutebusiness.com.